In this video, I will talk on the topic Have a Balanced Financial Health. My name is Kin Lian. I was formerly the Chief Executive of NTUC Income. Today, I'm the President of the Financial Services Consumer Association. My talk is targeted at slightly older people, 40 and above, but the points in this talk should also be of interest to younger people. Now, what is a balanced financial health? It means you should be able to retire from active work by age 65. You have sufficient savings for your retirement needs. You do not have any more debt. Your home is fully paid. You have adequate insurance to take care of medical needs. You do not have any financial worry. You are able to relax and enjoy your hobbies. Now, the key challenge to your financial health is to have adequate savings for your retirement. You need personal savings to supplement your CPF money, and you also need to invest your savings wisely. There are several bad investments that you should avoid. Your biggest risk is bad investment. You may lose most of your savings in scams, or you may lock up the savings in a long-term investment plan that gives you a poor return. Now, what are the investment scams? One category is called the Ponzi. The Ponzi gives you a high return, but it is a scam because that return is given to you by taking money from other investors. In turn, your money will be taken away to pay other investors. Now, a Ponzi scheme, how do you recognize it? It is likely to be an investment that pay you 1% or 2% a month. Now, that means 12 to 24% a year. When an investment pays such a high return, it is either very risky or worse, it could be a scam. Examples of Ponzi scheme are gold bar or growing trees to get this return. Now, where is the catch? The catch is that the Ponzi scheme operator takes money from takes your money when you invest to pay the earlier investors, and in turn they hope that there will be new investors that comes in that will make investment. They take their money to pay you. Now, the problem is somewhere down the road the whole scheme will collapse and all the investors who have invested will lose their money. Another scam which is quite common is land bank. Typically, the investor pays $80,000 for a 5,000 square foot plot of land. The investor thinks that this is a very good investment because land price in Singapore is 10, 20, 30 times higher than this. Now, the developer told the investor that they will apply to convert the land from agriculture to residential land, and after approval the land is expected to be worth 2 or 3 times what has been invested, and approval is expected in 3 to 5 years. Now, where is the catch? Well, the catch is there are hundreds, maybe several hundreds of this type of schemes in many countries, and in nearly all of these cases, approval is not given. The government does not give that approval, and the investors are stuck with the plots of land, and some of them invested in several plots which does not yield any income, and furthermore require monthly payment for upkeep of the land. Now the investor asks, can they sell the land back? Yes, you can, but the land is going to be worth very little. In fact, the price of agricultural land is probably $1 or $2 per square foot, so the land might be worth $5,000 or $10,000, not the $80,000 that you have paid for. Wine investment. The investor is invited for a wine tasting event. Usually a talk will be given on how you can invest in wine. There will be marketing people who will entice the investor to invest $10,000 in a basket of wine. They are told that they have to wait 3 years for the wine to be ready for auction, and the auction price is expected to be 1.5 to 2 times of the invested sum. And some people have made this investment. So where is the catch? Well, the catch is in 3 years time the auction is not held. There will be one excuse or another, and the investor is then told that their basket of wine is not adequate to go for auction. They are then asked to make a further investment to get a more adequate collection of wine to be invested. And the other option is yes, you can take back your wine and consume it, and you will probably find that you have bought the wine at twice of its actual market price. The market price at the time you make the investment is probably half of what you have paid for. Another category of products that you have to be quite careful about are financial products, and strangely these are products sold by banks, including the bank that you have trusted for many years. Now, the bank did not create these products. The products are created by third parties, and the bank sells the products to earn a commission. The person who sells the product, who is employed by the bank, may not even be aware about the flaws, the risks in these products. One such product are called the capital guaranteed products. They were actively sold during 2000 to 2005, and the investor has to put in a capital sum, maybe $50,000 for 5 years. They are told that the capital is guaranteed or protected, and they are told that you can get quite an attractive return, but that is contingent on certain events. Now, where is the catch? Well, many investors, perhaps a few 100,000 people have made such investments, They waited for 5 years and they got back their capital, but the return is extremely low, perhaps just 1% or 2% for 5 years. The event that's supposed to bring an attractive return never occur. So many investors have lost the opportunity cost of earning a return, a decent return on their invested sum. Another category are called credit-linked products. They are investment also for a period of 5 years or sometimes a little longer. They pay a, a return of 5% per annum. There is a risk, and you are told that there is a risk that you will lose your capital, or you will lose a part of your capital if a credit event occurs. That means if one of the institutions named in the uh, package, the investment package, defaults or go bankrupt. But the marketing person tell you this event is extremely unlikely to happen. Well, they are wrong, because during the global financial crisis in 2008, many of these investments have gone into trouble. Several of them have lost all of their values, and some have lost half their value. This is the example of the Lehman Brothers mini bond, but there are several other investments that suffer the same fate. Now, where is the catch? Well, the catch is although you are told that the credit event is unlikely, that is not true. Many people have suffered large losses because the credit event does happen. Another category of risky investments are called the currency link or the dual currency investments. The investor is told they can earn 3 to 5% per annum by investing in a foreign currency, but it is just their deposit is linked to a foreign currency. If the foreign currency does not drop below a certain level, they earn 3 to 5% on their deposit in local currency. But if the foreign currency drop, they have to take over the currency, but they are told they can wait for the currency to recover. Where is the catch? Well, there are currencies are volatile. There are many cases where the currencies have dropped below the target level. The investors have lost 50 to 100% of their investment, especially during a financial crisis. I've known of cases where people have lost $500,000 or more. And be careful, these dual currency investments are still being sold by the banks today, and they are marketed as a good way to earn an attractive return. You also have to be careful about investment-linked policies sold by insurance companies because these policies typically will take away 4% or more of your yield. For example, if the underlying investment earns 6%, your net return is only 2%. And usually investors were not aware because the product is misrepresented by the sales agent. And some of the investment funds are third-party funds, and they could be fraudulently managed. Now, many people are investing in these policies. There's a large volume of sales every year, and where is the catch? Well, the catch is you are not aware that the insurance company is taking away a large part of what the fund can earn, leaving you with a very low return. And during a bad period, you might get a negative return and still suffer the big deduction. You have to be careful about this policy, a 5-year investment that is now being sold, and they are recommended to you by the bank relationship manager. The customer may invest a large sum, maybe $50,000, thinking that it is a one-time investment. It is actually a life insurance policy that require $50,000 to be paid every year for 5 years. And the policy may sometimes mature, not at the end of 5 years, but after 10 years. Where is the catch? The catch is the customer thought it is a one-time investment, and then turns out to be an annual investment, and the customer cannot prove that he or she was misinformed. So if the customer cannot afford to continue the second year's payment, he may lose most or all of the first year investment. Now, if most of these investments are risky, what then is a good investment? Well, this is a photograph of a meeting that I held with Mr. Jack Bogle in 2007 in Pennsylvania, USA. Now, Mr. Jack Bogle founded the Vanguard group, and this Vanguard group created the index fund. And the index fund is the investment that I like to recommend to you, because there is an index fund available in Singapore. Well, you will probably recognize this gentleman. He's very famous, highly respected. He's Mr. Warren Buffett. And he says most investors, both institutional and individual, will find that the best way to own common stock is through an index fund that charges minimal fees. So he is also advising investors to invest in the index fund. Now, the index fund is invested in blue chip shares. These are the long, well-established companies quoted on the stock exchange, and they have been around for several dozen years. The index fund that you can invest in is called the STI ETF, the Straits Times Index Exchange Traded Fund, that you can buy through the stock exchange. You buy this ETF just like you would buy any share. This ETF earn 9% per annum on average over the past 20 years. Now, I expect the return in the future to be lower than 9% per annum, but it should be very much higher than most other types of investment. And the reason is you are earning the yield on blue chip shares. dividend yield about 2.5%, capital gains about another 3-4% in the future, and the fees taken away by the fund manager is very small, only 0.3% per year. Now, although investing in shares may appear to be risky, you can reduce the risk by diversification. That means you invest in an index fund, and the index fund in turn is invested in 30 blue chip shares in Singapore. So you do not stand the risk of making one bad investment because you are invested in 30 shares. The second factor is you should invest for the long term, 10 years or longer. Now some years may be very bad, you might get a negative return, but some years will be very good. So over the long term, your return is being averaged out, and it was averaged 9% per annum in the past. Perhaps in the future could be lower, but still quite attractive. And the third way that you manage your risk is you invest regularly with small sums of money, maybe every 6 months or a year. You can invest 3, 5 or $10,000. And when you withdraw, after you retire, you are also withdrawing regularly in small sums. You don't withdraw all of your investment, but you just withdraw in small sums every 6 or 12 months. Now about insurance, my advice is do not spend too much money on insurance. Insurance should take less than 2% of your income. You should buy term insurance or accident insurance. Why? The reason is never use insurance as your investment, because the insurance company takes away a very large part of what your money can earn and give you a very poor return after they have taken away their fees. Now Medishield Life, I advise you to stick with Medishield Life. Do avoid buying the integrated shield plan, as the premium rate is 1.5 to 3 times of Medishield Life, could even be higher than that, and the cost can be very expensive after age 70. So just stick with Medishield Life, but if you want to spend more, do take the advice of someone who can do the calculation for you. That's all, and I hope you find this talk to be interesting and useful. Thank you for watching this video. Goodbye.